welcome to episode 40 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event driven activity over the past week. My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
What we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts in the special situations world, as well as access to tools to help you identify opportunities, check out InsideArbitrage.com. Please take a moment to like and subscribe to this podcast on whatever platform you may be listening on.
We are continuing with our new format by focusing on 4 key stories, including multiple investors opposing the STAAR Surgical deal by Alcon, the acquisition of Akero Therapeutics by Novo Nordisk in a $4.7 billion deal, an intriguing insider purchase at Scholar Rock Holdings, and the appointment of a new CFO at Pepsi following activist involvement by Elliott Management. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more detail. We wanted to start this podcast off by looking at a few key headlines in the M&A world this week, starting off with rumors that the data streaming platform Confluent was exploring a sale. Limited details have been shared, aside from the fact that the company has attracted acquisition interest and is working with an investment bank after private equity firms and other technology companies expressed their interest. Thoma Bravo, the PE firm that's been on a roll recently acquiring software businesses, was one of the rumored names, and we'll talk about Thoma Bravo a little bit further in the rest of this podcast. The stock is up about 7% in the last week on this news, and I can see why acquirers might be interested in the platform that is rapidly scaling revenue while net losses are somewhat decreasing over time.
Another rumored deal from last week was reported by Wall Street Journal's Lauren Thomas, and it was about Johnson & Johnson being in talks to acquire Protagonist Therapeutics with the ticker PTGX. Protagonist, which has a market cap of a little over $4 billion, jumped nearly 30% on this news last Friday and now has an enterprise value of $5.2 billion. The company focuses on rare blood disorders, and its lead drug, rusfertide, which is in phase 3 clinical trials, helps treat a rare chronic blood disorder that affects about 150,000 patients in the US. We don't know if this deal will materialize, but combining the gains from last Friday, the stock is up 87% over the last year and up nearly 300% over the last 5 years. So it looks like if it does materialize, Johnson & Johnson is going to be paying up for this company.
So moving away from rumor deals into current deal updates, the TaskUs saga is one that we've been following very closely on our podcast for the last few episodes, as multiple minority investors came together to oppose the company's take private by Blackstone and its co-founders, claiming that the price deeply undervalued the business. The TaskUs saga ended last week when the deal failed to garner enough shareholder support in order to secure the last majority of the minority vote needed to pass. Blackstone evidently didn't revise the deal price any higher, so TaskUs ended up terminating the deal at the $16.50 share price. It feels like history is repeating itself in some sense because we're seeing a similar situation develop with STAAR Surgical.
I recognize the STAAR Surgical name somewhere. Didn't we used to see maybe insider purchases at the company a while ago?
Yep, that's exactly what I first thought when I saw the company. The name was so familiar. And we did used to see the 10% owner Broadwood Partners purchase shares all the time in early 2025. Keep that name, Broadwood Partners, in mind because we'll return to it shortly. Now, STAAR Surgical is an ophthalmic surgery company focused on lenses for the eyes, and it entered into a $1.5 billion deal to be acquired by the much larger eye care company Alcon, which works out to roughly $28 per share in cash. Unlike the TaskUs situation, the deal isn't trading at a negative spread. STAAR Surgical is trading at around $26 at the moment, representing a spread of roughly 5%. However, much like the TaskUs deal, many investors have stepped forward to oppose the deal. Immediately after the deal was announced, Broadwood Partners asked for the company's books and records to evaluate the deal-seeking process. By September, Broadwood Partners, which owns a 27.3% stake in STAAR Surgical, announced that they intend to vote against the proposed acquisition claiming the transaction suffers from multiple process and valuation deficiencies. On September 22nd, Yunqi Capital, a 5.1% shareholder of STAAR Surgical, also announced that they opposed the deal, claiming the $28 per share bid deeply undervalued the business. At the start of this week, Defender Capital, which owns only about a 1.5% stake in the business, also joined in and announced their opposition to the deal. And what really gave us a sense of deja vu was how the proxy advisory firm, Glass Lewis, is also arguing against the deal, much like how the proxy advisory firm ISS opposed the TaskUs deal.
I hope the outcome here is better than what the TaskUs shareholders, including me, experienced. I remember there were shareholders that were saying that the stock was worth as much as $19 or as much as $25, and they were not happy with the $16.50 price. And now the stock is trading a little over $13 per share now that the deal has failed. In the case of STAAR Surgical, is shareholder approval the only consideration here?
So, no, not quite. The waiting period under the HSR Act expired at the end of September, essentially granting the deal some level of approval in the United States. However, the acquisition still needs to be approved in a number of other countries like China, Japan, the UK, Saudi Arabia, and more. The deal is expected to close within 6 to 12 months, which is a fairly large time frame, which could also explain why the spread isn't negative.
Talking about new M&A activity, we have discussed the liver disease MASH several times on this podcast in the context of an insider purchase of Madrigal Pharmaceuticals by the successful biotech investment firm, the Baker Brothers, in August, as well as the acquisition of 89 Bio by Roche in September.
Yeah, Madrigal Pharmaceuticals we've featured on this podcast multiple times, especially considering that it's the largest position in John Paulson's portfolio. Paulson is a legend in the merger arb space, and he made a significant amount of money shorting the housing bubble during the Great Recession, but unfortunately also made a lot of early bets with both gold and Madrigal Pharmaceuticals. However, it looks like his concentrated positions in these two investments or spaces have been playing out in the present.
The liver disease MASH is showing up for the third month in a row, and this time in the context of Novo Nordisk acquiring Akero Therapeutics in a $4.7 billion deal that includes a contingent value right or CVR. Before we get to the specifics of the deal, it is worth noting that MASH is an obesity-related disease where excess fat builds up in the liver and can cause inflammation, scarring of the liver, which is also known as cirrhosis, and even cancer. Some of the current crop of weight loss drugs are having a positive impact on obesity-related diseases, and on August 15th, the FDA approved Novo Nordisk's GLP-1 drug Wegovy, typically used for weight loss, to treat MASH as well. Last month, Roche agreed to acquire 89 Bio for up to $2.4 billion to expand its presence in MASH. Earlier this year, GSK purchased a potential MASH treatment for up to $2 billion from Boston Pharmaceuticals. Both the Roche deal and the GSK deal had CVRs or milestone payments. And as you know, we really love tracking CVRs on Inside Arbitrage. The whole thing brings us to the acquisition of Akero Therapeutics by Novo Nordisk. The deal is structured as an all-cash deal for $54 per share in cash and a CVR worth as much as $6 per share if Akero's EFX drug for the treatment of cirrhosis due to MASH receives FDA approval by June 2031. This is one of those rare instances where the deal is trading just below the $54 per share cash price, making the CVR a free lottery ticket to a future payment of $6 per share if the deal closes as expected by the end of the year.
CVRs are always fun situations, but another acquisition that stood out to us was the acquisition of Comerica Incorporated by Fifth Third Bancorp for a closing value of $10.9 billion in an all-stock deal. In July, Holdco Asset Management, which owns about 1.8% of Comerica, had urged the company to begin a sales process immediately. The stock was trading at around $69 before Holdco pushed for a board overhaul if the company fails to take action to increase stock performance. So this is a deals in the works situation pushed for by an activist that eventually materialized in an actual deal. Comerica has about $78 billion in assets and a market cap of $9.75 billion. while Fifth Third Bancorp has about $212 billion in assets and a market cap of $27.45 billion. So this combination isn't going to create the next JP Morgan by any means, but will certainly create a bank with significant AUM and presence. The deal is expected to close at the end of Q1 2026.
So this will create essentially one of those few handful of super regionals that exist. It'll be interesting to see if this deal is allowed to go through by the FDIC and other regulators that have to review bank deals, which is why the closing for these bank deals usually tend to take a really long time. Switching gears to spin-offs, investors are looking at both robotics and quantum computing as the next frontiers that could potentially see the kind of enthusiasm and returns that AI and crypto have seen over the last few years. While there is a lot of talk about autonomous vehicles and humanoid robots like Tesla's Optimus and Figure's O3, one of the largest robotic divisions in the world with real revenues was going to be spun out of the larger company that held it. ABB is a Swiss Swedish company that operates in over 100 countries and is a leader in electrification, automation, and more importantly, robotics. As we mentioned in a prior podcast, ABB's robotics division is the second largest robotics manufacturer in the world with $2.3 billion in revenue in 2024, representing 7% of ABB Group's total revenues. When the company first announced earlier this year that it wanted to spin off its robotics division, it was estimated that the division was potentially worth over $3.5 billion. I was looking forward to this spin-off, but it looks like ABB received a much more lucrative offer from SoftBank, which agreed to pay nearly $5.4 billion to take the company off ABB's hands. The SoftBank deal is expected to close by mid to late 2026, and ABB will recognize a $2.4 billion gain on the sale, which is nice for ABB shareholders, but quite frankly, I'm a little miffed that I missed out on this opportunity to own a pure play robotics company.
Moving on to stock buybacks, our favorite cannibal, which refers to a business that is constantly repurchasing large portions of its outstanding shares on the open market, is back. AutoZone, which retails automotive replacement parts and accessories, just announced a $1.5 billion buyback. While its additional $1.5 billion buyback only represents 2.24% of the company's market cap at announcement, over the last 4 years, AutoZone has repurchased over 20% of all shares outstanding. Unsurprisingly, the company's stock is up about 30% in the last year alone, and up a whopping 256% in the last 5 years, which is bolstered by the business's strong revenue and net income growth and fairly strong free cash flow as well. That being said, the company does have about $12 billion in debt, but compared to its market cap of $68 billion, we aren't all that concerned about being over-leveraged. AutoZone is slightly expensive, trading at a PE ratio of 28 and an EV by EBITDA of 19.19. However, this might be a situation where you pay up for growth and management, who appears to be committed to delivering shareholder returns.
When EV sales started spiking, we first thought that, this means there'll be less business for the companies like AutoZone because you have less moving parts and less parts overall in EV vehicles. But we have yet to see that have a considerable impact on the company. But I think it should be a risk that investors in auto replacement part companies, whether it's a retailer or a manufacturer, should be concerned about.
Absolutely. It's a hallmark of a changing industry, and that would affect secondary players like these auto replacement part businesses.
Absolutely.
All right, continuing on to the insiders section of our podcast, our favorite insider to come across are independent directors with an investment background who also have deep industry experience. In a week where the actual number of insider purchases was quite low, we found the nearly $19 million purchase of Scholar Rock by Srinivas Akkaraju fascinating for multiple reasons, including his background. We were shocked to see Mr. Akkaraju score a perfect 100 on our new insider performance score metric. He joined Scholar Rock's board in July 2022, having been the founder and managing general partner of Samsara Biocapital. Previously, he held significant roles at a number of life sciences-focused investment firms, having started his career at Genentech and JP Morgan Partners.
Yeah, I was surprised to see that he scored a perfect 100, and that's what drew our attention to him. The other person we've seen who has done very well is Jay Hogue, who's been on the board of directors
Mm-hmm.
of Netflix and Zillow. He scores
Mm-hmm.
very high on our insider performance score metric as well. But what does Scholar Rock do beyond Mr. Akaraju buying? Is there something interesting going on with this company?
Yeah, honestly, with a name like Scholar Rock, you'd expect the business to be some sort of educational company, like Lincoln Educational Services or Universal Technical Institute. But instead, Scholar Rock is a biopharmaceutical company. Scholar Rock's pipeline is largely driven by apitegromab, a phase 3 drug that is currently awaiting FDA approval. Apitegromab is the first ever muscle targeted therapy for spinal muscular atrophy, working by selectively blocking myostatin to help patients build and preserve muscle strength. There are 3 possible treatments for SMA that currently exist in the United States. Biogen Spinraza, which is incredibly invasive, requiring lumbar punctures every 4 months. Roche's Evrysdi, which rapidly captured market share due to its oral delivery method of either a daily tablet or liquid dose. And the last treatment option, Zolgensma, which is developed by Novartis and is meant to be a one-time gene therapy via IV infusion. However, around 30% of patients require additional SMN-targeted therapy around 7.5 years after treatment.
So where does apitegromab fit in?
So, all these existing therapies target the SMN pathway, as in they increase the production of survival motor neuron proteins to slow motor neuron degeneration. However, none address the muscle atrophy that occurs downstream from motor neuron loss. Apitegromab addresses this gap as the first therapy specifically targeting muscle preservation and growth, positioning it as an add-on combination therapy rather than a competitor to existing treatments, meaning it's able to work with all 3 of these existing therapies and capture even more market share than any of them alone.
And so, what's been stopping this drug from getting approved? I understand it's in the phase 3 trials already at this point.
Yeah, it's actually completed phase 3 trials. Scholar Rock had submitted the drug for approval by the FDA on January 29th of this year and had been granted fast track, orphan drug, and rare pediatric disease designations, with a priority review date of September 22nd, 2025. However, on September 22nd, the FDA issued a Complete Response Letter, or CRL, which is a formal notification by the FDA that an application for a drug or biologic is not ready for approval in its current form. Most importantly, and unlike most CRLs, the CRL issued for apitegromab contains 0 concerns about the drug efficacy, safety, clinical data quality, or the drug's substance manufacturing process. Instead, the CRL cited concerns at Catalent's fill-finish facility in Indiana during routine inspection. The facility was once owned by Catalent, but is one of 3 plants that was passed to Novo Nordisk when Nova Holdings acquired Catalent in February 2024. By August, the FDA had identified critical lapses at the production facility, including cat hair, bacterial contamination, and instrument defects, which is shocking on multiple levels.
Indeed.
Other than the issue of the CRL, apitegromab faces some minor competition as well. Roche is currently developing another anti-myostatin antibody that functions similarly to apitegromab and is currently in phase 2 trials. Biohaven was also developing a similar drug, but that drug ended up failing its phase 3 trial in 2024, indicating that Scholar Rock is able to succeed where many other companies have failed, and thus it is able to retain first mover advantage when it moves to commercialization. We always say we aren't biotech investors, but frequently find ourselves drawn to situations like this one. There's a lot more to Scholar Rock, and I cover the company in more detail in our Insider Weekends article published this week.
I remember when Novo was going through the acquisition of Catalent, there were some concerns about what would happen after the transition would take place and whether other drug companies that were also using Catalent would face problems. And it feels like to some extent, some of that has come to play. The deal was eventually approved, but it took a while for the approval to come through.
That being said, I think the Catalent facility has been facing issues since early 2022, so this might be more on Catalent than it is a transition from Catalent over to Novo Nordisk.
That makes a lot of sense. Switching gear a little bit to activists. A couple of months ago, we talked about Thoma Bravo, a software-focused PE firm with $184 billion in assets under management, and they announced a $12.3 billion acquisition of Dayforce, a company that focuses on HR software. I mentioned back then that I looked through our M&A database to see how many Thoma Bravo deals I could find over the last 15 years, and they accounted for 35 deals. We don't often see shareholders oppose Thoma Bravo deals because they usually pay a good premium to acquire the company. And in the case of Dayforce, the premium to the unadjusted price before rumor about the potential deal came out was 32%. However, this time, T. Rowe Price, which owns a 15.5% stake in Dayforce, issued an open letter against the acquisition by Thoma Bravo. They wrote that they were investors in Dayforce's IPO in 2018 and over the last 6 months increased their holdings to about 25 million shares, making them one of the largest shareholders of Dayforce. They believe that after years of investments, the company is now at the cusp of delivering $1 billion of free cash flow per year for several years. Dayforce went public at $22 per share, and if T. Rowe Price got in at the IPO, they have done very well considering Thoma Bravo is paying $70 per share for the company. However, if T. Rowe Price added to their stake, especially earlier this year, then that portion of the stake is likely to be underwater even at the $70 acquisition price. The whole situation reminds me of how T. Rowe Price opposed Oracle's acquisition of NetSuite in 2016, but that deal closed on original terms. And so we'll have to see if this is a repeat of that process or if T. Rowe Price manages to get a higher price for Dayforce. Speaking of activists and C-suite transitions, we normally focus on CEO transitions in the C-suite transition section of this podcast, but we felt that it was worth mentioning a CFO transition this time. Pepsi, which we covered last month because of Elliott Management's involvement with the company through their massive $4 billion stake in the company, appointed a new CFO last week. Stephen Smith comes over from Walmart, where he spent 4 years as the CFO of Walmart's US division. Walmart stock was up about 135% during his tenure at the company, but a lot of that could also be attributed to CEO Doug McMillon, who over his 11-year tenure at Walmart returned the company to growth, and the stock appreciated more than 350% over the last 10 years. Not bad for such a mature company that is facing competition from the likes of Costco. Getting back to Pepsi, if a large behemoth like Walmart can return to growth, maybe Pepsi can do the same without relying too heavily on acquisitions as it has done in the past.
So we've been talking a lot about food products companies on this podcast and drink companies. I think last was KDP, and they were separating into a separate business beverage to operate in North America. And what we talked about is that Pepsi and Coke have always been the two major players in this space, and competition has been tough for everyone else. But how is Pepsi specifically compared to Coke?
Well, both companies have gone on acquisition binges, right? So, as they felt like people stopped drinking carbonated sugar syrup or soda and moved on to healthier drinks, both have gone on acquisition binges, which have left their companies with leveraged balance sheets, especially Pepsi has growing debt on its balance sheet. So, for Pepsi at this point, I think the focus needs to be on internal operations, considering Pepsi's net margin is just 8% compared to Coke's 26% net margin. So, quite a lot of opportunity out there. In that context, poaching Walmart's US CFO makes a lot of sense. And with the guiding hand of Elliott, hopefully Pepsi stock, which is down 15% over the last year, can get back to positive territory.
We wanted to wrap our podcast up with a look at Verizon, who announced that Dan Schulman would join as CEO, effective immediately. The former CEO, Hans Vestberg, had been in his role for 7 years, and yet the stock was only up 8% during that time. Dan Schulman had served as the CEO of PayPal from 2014 to 2023 and has held a variety of executive and board positions at major businesses like Norton LifeLock, American Express, Priceline.com, and AT&T. Funnily enough, Verizon stock ended up dropping after the news. Verizon has seen revenue increase quarter after quarter, but this revenue was driven by price increases rather than customer acquisition. Postpaid phone subscribers are the industry's most profitable customers, and Verizon reported a staggering loss of 356,000 customers from that postpaid phone subscriber segment in Q1 2025, and then an additional loss of 51,000 in Q2. Network quality alone no longer seems to be a sufficient driver of customer acquisition, and competitors like T-Mobile have definitely closed that network perception gap, such that the decision to switch becomes a lot easier. Hopefully, Dan Schulman is able to turn this company around.
That's not surprising considering we switched to T-Mobile as well, and T-Mobile has gained a lot of market share, not just through its acquisition of Sprint, but also taking away consumers both from Verizon and AT&T.
Absolutely. And with that, we will wrap up episode 40 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed on this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.